Welcome to another edition of Mwango Spaces this Wednesday, 11th March 2026. Very privileged to have the CVA4 of Stanbic Holdings. A lot has happened since we last hosted him. He's going to take us through the FY25 results. So Dennis, over to you to start off by giving us a bird's eye view of your FY25 result in the context of the overall group strategy. And then I'll pick a few things here and there so that we can dig in.
Thank you and good evening, everyone. It's really a pleasure to engage with you on this platform, share a bit of the Stanbic Holdings story for 2025. And if time allows, we can take a sneak peek at 2026 and some of the things we are doing and how we continue to execute on our strategy. I think it's best that we start this conversation on the strategy that we are working on at Stanbic Bank. We have chosen three very important pillars as the things that we want to execute in strategy. The first being transforming our client experience. And the way to think about that is, how do we make it easier for our clients to just live their lives and then bank on the side and enjoy financial services from Stanbic Group on the side? And the reason why I'm avoiding using banking services is because we've got more than banking services. So that's the first kind of pillar that is supported by people. So how do we also ensure that we are keeping tabs with how we watch out for the welfare of the teams that we have to ensure that they serve our clients? I've read a couple of times that when you take care of your people, they take care of your clients and your business. Then the second pillar we've chosen to drive is executing with excellence. And again, we have two sub-pillars there. The first is we're in a risk-taking business, so there's no running away from that. So how do we continue watching out how much risk we take and how much return we derive out of taking that risk? The second piece to that being operational excellence. So how do we ensure that the well-oiled machine that serves the clients on the front end with excellence is not a Rolls-Royce at the front and then a Mazda at the back? I have no problems with Mazda. I have driven one. But how do you ensure that there's a symmetry between the front and the back from an operational excellence perspective? And the third piece is driving sustainable growth and value. Now, the key word to underline here, and our board keeps on reminding us, this is sustainability. We don't see value in driving a business that shoots out the lights during Dr. Oigara's tenure, and then when he hands it over to the next leader, then it goes into oblivion. And that's anchored on the things we do to ensure that the financial metrics are anchored on proper economic activity that is supported by our clients. It's ensuring that we remain a responsible citizen, whether you talk about the communities we interact with, whether you talk about being responsible to our regulators, being responsible to the revenue authorities. All that kind of boils together into that creation of sustainable value. If I can give a sneak peek of how we've done on each of those things. So we'll talk about client focus. We did do some work in 2025. We did successfully actually support the government in the 1.5 billion Eurobond transaction. There's a lot of stuff that we did. If you go to our website, you will see the investor pack there. It does call out a few of those things. We actually disbursed 70 billion shillings to SMEs. And I like that part because we can disburse, I don't think capital would allow us to do that, but we can disburse that similar amount, maybe through the cycle, to one legal entity or one corporate entity. But 70 billion shillings, assuming an SME is borrowing 100 million shillings, so you're really disbursing a lot of money to a lot of people and driving a lot of business. On the people side, just some highlights. We do have a very well-balanced staff. We've got a 51 to 49 diversity between male and female. We did offer 39 youths internship opportunities. And this is basically creating opportunities for people who will come after us because we're not going to be there. On executing with excellence, this is the one part where we do extremely well. Our NPL ratio is at 8%, and that's really market leading. Our cost of risk or credit loss ratio is actually just below 0.6%, which is something that we are very proud of. And yes, we have been at the forefront of adopting the new risk-based pricing formula, which was communicated by the central bank, or guidelines were provided by the central bank. And then we did build a formula for our board to approve. And then on operational excellence, quickly, we have 21 bots, AI bots that we use, whether it's for our reconciliations, whether for credit modeling and availing limits to our customers, whether it is for risk management in the form of fraud risk management, etc., etc. So we have capabilities that are helping us look at what we know about Mokaya, and if we see Mokaya is transacting at 2 a.m., we can say, hang on, we have not seen Mokaya transact at 2 a.m., and therefore we would stop that to basically hold value for our customers. And then the last part is the sustainable value. 267 new homeowners we created in 2025. We lent 10% of our new facilities in 2025 to the retail sector, which most of you would know is actually 23% of our economy. We did do a small part in repairing the damage that we as humans do to the environment by planting 204,000 trees, particularly mangroves, and I'm proud to have particularly planted a number of those in Malindi towards the end of last year. And yes, we continue to support our women customers, entrepreneurs, women-led businesses. In fact, since we launched the DADA program, the Dare to Aspire, Dare to Achieve program, about 3 years ago, we've lent 49.5 billion shillings to that class of Kenyans. So that was summary. Mokaya, I've summarized our strategy and what we've done.
Thank you so much for that, Pete. I think it's good to put the context of the financial year results in the context of the broader strategy of the company and the bank as a whole. I want to perhaps start on an easier footing. There is usually a bit of confusion around Stanbic Kenya, Stanbic Uganda, Stanbic Holdings, Stanbic South Sudan. So perhaps you can give us a little bit of a flavor on how the structure of the bank is so that people can put it in context when the results come in.
I'm very happy to do that. I know it can be a little confusing. So let's start from the bank, which is really the main entity, and I'll tell you why I call it the main entity. We've got Stanbic Bank Kenya Limited, which has about 42 points of representation across the country, both fully fledged branches and other lighter point of representations where customers can go and engage. And then we've got a branch in South Sudan. So we've got a branch. So that Bank Kenya has a branch in South Sudan. If you think about it, it's basically the same as Kenyatta Avenue branch. It's only that it happens to be in a different jurisdiction. We consolidate or we pull the performance of that business into the Bank Kenya. That Bank Kenya is owned 100% by Stanbic Holdings PLC. That is a listed entity. So for the investors who are in the call, you own shares in Stanbic Holdings PLC. That Stanbic Holdings PLC owns the bank that I've just described. It owns another two entities, SBG Securities Limited, which helps customers with their securities trading, and it does some transaction advisory work. And then we've got Stanbic Bancassurance Limited, which intermediates bancassurance, business or insurance services for clients and others. So those are the entities. Of course, we've got a foundation on the side, which is a subsidiary of the bank. But let's just stay with those three commercial entities. We've got a bank with a branch in South Sudan, got a SBG Securities, you've got SBIL or Bancassurance. Those three are 100% owned by Stanbic Holdings PLC. That company is listed in Kenya, but it's 74.92% owned by Standard Bank Group. So when you hear association with Standard Bank Group, then that is a 74.92% ownership. Then you got Stanbic Uganda, a similar percentage owned by Group directly, not related to Kenya. Then there's Stanbic Tanzania again. So all these banks in various countries, except for South Sudan, are directly owned by Standard Bank South Africa. Now, Standard Bank South Africa then operates a regional model, because you can imagine all those direct ownerships in its structure. Then they have regional chief executives, and Joshua is then proudly the Standard Bank East Africa region CEO. So he looks after Kenya plus its holding South Sudan, looks after Uganda, looks after Tanzania, looks after Malawi. So that is how it is organized. It just so happens that he is also part of Stanbic Holdings PLC as the CEO. I hope I have not created more confusion.
As you were saying that, I just posted from the annual report in 2024 on our timeline. I just posted a nice picture. Someone can easily get the footprint that you have across the region. I think it's very important. Today, there was an announcement about the CEO of Kenya. So sometimes people don't know where it is within the group structure. So I think it's very important so that when you're discussing results, people know what we're discussing.
Exactly. And that's actually a very good opportunity for me to congratulate my brother, Abraham Ongenge, who has been appointed the acting chief, of course, subject to regulatory approvals, for Stanbic Bank Kenya. Remember now what I've just described. He's now the chief executive for Stanbic Bank Kenya, looking after Kenya and our operation in South Sudan.
So today we are discussing the results of Stanbic Holdings, right?
Yes, we are.
Let's dissect that. Top line, how was that?
I think let's just admit 2025, and I've looked at a couple of banks that are published now. I do closely track bank results. I did analyze the Q3 results. We did see a lot of activity on the balance sheet, whether it is on customer activity or financial investments or other vectors of growth. But we did see a bit of malaise on the income statement. So how do you then explain that? Particularly for ourselves, we've got a 19% growth on the balance sheet, which is quite a number, and I'm very happy with that. And it's good because the growth is actually mostly on customer assets. You've got a 540 billion balance sheet, out of which half, 272, is actually customer assets. So if that number moves, then you see the movement in the balance sheet. So growth in the right areas, customer deposit up 18%. But that same year, we did have significant reduction in margins and pricing. If you remember when we woke up in 2025, I think our benchmark rate, the CBR, was closer to 12% plus or minus at the time. It is now 8.75. So we had a cumulative 225 basis points cut. At the time, the T-bill rate was above the benchmark rate at around 16%. In response to the directional views provided by the CBR cuts, that actually overtook a CBR going downwards and has been hovering around 8%. So you've got 800 basis points of yield that then came off from our book. In the grand scheme of things, I don't think that is necessarily a problem, because to the extent that those actions have led to resuscitation of private sector credit growth, which, as we all know, at the start of the year was very anemic, I think that's a good place for us to find ourselves. We also had the double whammy of a very cold FX margins market. Some of you might remember that our currency touched 160 plus or minus at the end of 2023, early 2024. And a lot of that was driven by jitters around our June 2024 $2 billion Eurobond, which the government successfully navigated. And then after that, it came down and settled at 129. And for the last going to 2 years, actually more than 2 years now, it's been around that 129 area plus or minus. When you have an environment like that, FX margins are muted. So what am I describing? Good activity and a lot of effort on the balance sheet and client activity, and I've described that in the investor calls that we've had today, but muted pricing, giving us a 3.1% reduction in revenue year on year. So that's really the top line, Eric.
I was just doing quick math. I think it was around 225 basis point cast across 6 cuts in 2025. So usually that impacts the banks straight away because you have to reduce rates. In terms of Kesonia versus CBR and rate pricing toward the end of last year and the beginning of this year, there was a deadline by the CBK to change how generally loans are priced. How is that going and how is it impacting you? How are customers responding also?
Customers respond early days because for the most part, the customers who we had already lent to, we only migrated at the end of February. And on Kesonia, the determination of the price is the compounded average up to 5 days before month end. So we're going to determine the rate for sure towards the end of March. For the customers that have borrowed between 1 December, which was the new lending, 1 December to around now, we've seen about 90% of the eligible customers or eligible facilities. And I say eligible because there are some facilities that are not eligible. Foreign currency lending is not eligible for this. Fixed rate loans are not eligible for this. Those are ineligible. The ones that are eligible, we have seen close to 90% on Kesonia and another a kind of 10% plus or minus on CBR. I think that ratio is going to evolve. It's probably going to settle at 75-25 or 80-20 plus or minus. There's some observation period. I think it's been well received, and I think it's been well received in the market in the context of the spirit. The spirit behind all this is, can we transmit as best as we can the monetary policy pronouncements and intentions as fast as we can to the customers? So to that extent, it's been well received. There are some customers that feel uncomfortable with the uncertainty of not knowing what their loan repayment is likely to be at the end of the month. Because if you're going to only determine the rate towards the end of the month, and you and I don't have corporate treasuries at home tracking at the interbank rate on a daily basis. Corporates, a Safaricom, EABL, may have treasurers who can do that. The retail customer may struggle with that. So some of those we have seen almost an inclination towards, give me CBR, I just want to pay under 1,000 shillings or 80,000 for my mortgage. Don't do a lot of complex math. So that's the reception. But I think overall, it's been well executed. I'm very proud of the team at the bank that has led this initiative, led by our treasurer, coordinating with all the product managers to just get it over the line and ensure that we can serve our customers without disruptions.
We've looked at the interest rate. So to speak, your net interest income is just about stable. What was your secret there in terms of the rates were down significantly? How did you manage that?
Interest income on customer loans reduced by about 10.7 billion shillings, if I'm not getting my maths wrong. Actually, interest income reduced by 11 billion shillings flat. Then interest expense reduced by 10.7 billion. So you can almost see those two are cousins in terms of how they trended. So I've explained how interest income moved. How did the interest expense move? A bit of that interest expense is actually tied to the treasury bill. So if you've got some fixed deposits, the customer will ask you for T-bill minus 100 basis points or 200 basis points plus or minus. If the T-bill moves from 16% to 8%, you've got a credit note of 800 basis points on the funding side. But more importantly, we did a lot of work in just looking at the profile of our funding between what we call term funding and transactional funding. In banking terms, you hear things like CASA, which is current account and savings account, vis-a-vis your term or fixed deposits and call. And as we have been driving transactability, and Eric, you and I remember I made this comment when we last spoke that we are really keen on driving transactability from our customers. It's starting to show some green shoots because last year our CASA ratio was, last year in accounting world is 2024. Our CASA ratio was about 75%. It's now ticked up above 80% at 81%. What that does, it gives you a more stable, lower cost of funding liabilities. So you then pay a little bit lower interest expense. So how do I explain the 10.7 billion reduction? A rebase of the term funding and a restructure of the funding profile linked to driving up transactability.
Let's switch a little bit to the non-interest side. You alluded to it, that currency was pretty stable in 2024. I think it hasn't moved in a year and a half. That's usually good because then you can be able to transact a bit better. Has that impacted your loans? How are customers responding to that? And what drove the non-interest revenue at the decline in 6.4%?
So our non-interest revenue came off cumulatively 1 billion shillings in gross numbers from, I think, 16.4 to 15.4. So ballpark numbers, about $1 billion. Now, there are two main contributors really to actually three to that number. The first is FX. The second is trading activity, which is market making activity through market yields, etc., etc. Basically taking profit or taking risk on some positions. You will see in the detailed financial statements, there's things called fair value through profit or loss, or fair value through complex things accountants think about. But that is another classification. And then the third one is fees and commissions. Where does that come from? A, transactability. B, because of our investment banking business, we also do have some advisory fees. So let's unpack each of those. We've gone down $1 billion. How did that movement happen? FX income went down 3 billion from 6.9 billion to 3.9 billion. So that created a real hole in NIR or non-interest revenue that we needed to fill. So how did we close it from 3 billion hole to a 1 billion unmitigated hole? The first was trading activity. So there was a bit of market making opportunities, especially as the yields came off, which we took through a risk market making teams. And then B, the transactability story comes back. Remember, we spoke about more customers transacting on our channels. We did see digital transactability, for example, go up 12% in our retail customers and about 22% in our SME customers. That is activity that earns us fees. And then we had a good year on the advisory side of things and the structuring side of things in investment banking. You may know, or some of you may have heard about our corporate development market or corporate actions in 2025 was not very muted. So that also created a bit of that help. And then the last point is about our diversification of our business. 2 years ago, we didn't have an asset management business. We now have that asset management business that we created or we launched in September 2024. And that business in 2025 actually made us about 60 million shillings in fund management fees. That's what has created that stickiness and that protection in the NIR line.
100% increase in asset under management. That's a really good thing. I think that's 5.3 billion as at the end of 2025. So pretty robust. Asset under custody are up 34% per year. A CAGR of around 24% for the last 4 years. So pretty impressive overall what you're doing there. Is it a good chance to pitch to our Nanchi why they should come and invest alongside you? As perhaps you can take that opportunity, Dennis, to just pitch that.
I will never decline an opportunity like this. I will probably just talk about a bit of history and how we've created wealth for those who have given us capital, because there are people who have taken risk with our board and our management team. And I'll probably just go back a few data points. If you give us your money on 31st of December 2022, the value of Stanbic Holdings PLC was 40 billion shillings. So if you invested in the entire company or in the entire group that I've just described, it was worth 40 billion shillings. If you went to bed at that time and you woke up yesterday, the value of your company would be 101 billion shillings. So we've more than 2x'd the investment that you made. And there is really, that is the market pricing. So maybe there's a bit of market sentiment to it, etc., etc. But if you went to bed the same time, December 2022, you would have left us with a balance sheet of 390 billion shillings. When you wake up as of 31st December 2025, because I can't tell you about 2026 yet, you would come and find that you've got a balance sheet of 541 billion shillings. In between that period, we've created about 150 billion worth of additional balance sheet, which is actually another bank, if you think about it. And to the investing public, you've got a board, you've got a team that is focused on creating value and go out there and invest in Stanbic. And our strategy remains intact, aware of market dynamics and responding as proactively as we can to ensure that we can create more and more shareholder wealth. And by the way, I think market has agreed that Stanbic is probably one of the top 5, if not top 3, most yielding from a dividend yield perspective. We've just given back close to 20 billion shillings to our shareholders in the last 2 years, which is quite admirable.
We start with the revenue side, then interest income and the interest income side. Cost efficiency a little bit. Could you speak to us a bit about the increase slightly the operating expenses? What are you doing there in terms of cost to income ratio? And then in terms of also credit impairments, you're down sharply around 47%. You have a single digit, I think, NPL ratio. What are you doing that other people are not doing? And what's your secret sauce?
So we do take pride in risk management, and particularly because banking is actually that. It's just risk management. I come and take your deposits. I go and borrow some capital from people who trust that we can do some business. And then I go and give that money to people for 20 years, for 15 years, for 30 years. And those customers cannot come back. And I say to them, oh, sorry, we gave this money to Eric. He's built a big home in Karen. So sorry, wait for until he comes back and then we can give you back your deposit. I don't think you will tell the teacher that or a salaried person that and they'll listen to you. So it's really that, it's managing the risk in the portfolio. How do we do that? We have some established competencies in appraising and really exercising a lot of diligence in the customers that we bank. We have done a great job, and I'm really proud of the team and the bank of relationship managers who talk to our customers every single day to just check on how they are doing, how their business is doing. And then when things go south, because they do go south every so often, it's sitting with the customers, understanding that life hasn't turned out exactly the way it was planned. Something has not gone the way it was expected to go. And let's sit together and try work it out. That sometimes entails restructures, it entails the profiling of the repayment schedules, it requires enhancement of some of the credit terms, whatever it takes to just ensure that in the end, the customer succeeds and they're able to repay their facility. Very happy with the story of impairment. That reduction is largely on account of some customers who hit some winter periods in the previous years, particularly when rates were high. So what happens when rates are high is that customers are generally paying higher interests and less repayments on their capital. When rates start coming down, there's a bit of buoyancy and there's a bit of a breathing space in the wallet or in the business income statement. And then they can come now and recover some of the arrears that might have accumulated in the previous periods. And we did see a little bit of that come through. I should say that is not credit to just the fact that things happen. I am super proud of the team that drives our recoveries in the bank, really working with our business relationship managers, talking to customers to ensure that we can navigate these complexities. On cost efficiency, I'm actually very happy with an 18 billion cost print all in for this business. I know the cost to income ratio first ticked up about 100 and something basis points. I'm just looking at my notes. That's about 180 basis points from 44.4 last year. But that's actually, I blame revenue. I think if I just held revenue flat, then that CTI would have been in the region of 44.5, 44.6. So quite happy with the costs that we have printed. And it is not just the cost as a number, it's the quality of the cost. In there is a 50% plus or minus, which is about rewarding our teams for the hard work that they do. They put in a big shift to support the clients, to run operations internally, our technology team to keep the lights on, etc., etc. In there is investments in digital channels to serve our customers. We have a very well-rated mobile app. We are coming to the market to our SME customers with a very progressive all-in digital platform. We just invested in our core banking platform upgrade not so long ago. We just invested in a fraud monitoring tool, the one I was referring to, that can detect some unusual transactability in our customer account. Now, customers call back and say, man, you saved me. I would have lost this money, or I was duped, but you actually saved me. Those are costs we are willing to take, because even if the cost to income ratio ticks up, the trust our customers have with us, we do credit that account. We might have a debit on the OPEX, but we credit the account of trust with our customers.
So in 2025, rates declined, as you say, around 225 basis points. And that seemed to have boosted a little bit the loan department. 24% growth in loans and advances after years of most banks being called lazy bankers. I think that's really commendable. So what's in there? Can we dig in a little bit? What does G2G have to contribute there? And have you seen a recovery across the sectors in terms of credit demand? Like some of your peers also telling us, are there some sectors where you're seeing a bit more interest for planning for the elections next year? What do you see there from your vantage point?
The biggest driver has been on term lending on some of the bigger infrastructure related, energy related transactions where we've supported certain corporates that are doing those projects. About 45% of the growth is coming out of that area. Then we've got about 30% plus or minus that is supporting what you call G2G. We continue to call it just oil companies facilitation through LCs, but of course they hit the balance sheet every so often after certain milestones have been met. We did close 2025 with 3 of those LCs on the balance sheet compared to the previous year where most of them are unwound, and we were sitting with each of them gives you close to 9 to 10 billion shillings on the balance sheet. They do then create a bit of a fluctuation on the balance sheet. But even if I remove the impact of that, our lending activity, our customer loans still went up about 11%. So if I remove from the base and I remove from 2025, about 11%, compare that to where we've seen the industry at around 6.3% or 6.5%, there's still some quality growth in our business. And then I've talked about the 30% or 45%. The remaining 25% is actually the one that makes me most excited. Those are new homes that we have facilitated people to own some homes. We still have an offer that is going on, by the way. Here goes my salesmanship. Again, of 8.9% for mortgages up to 10.5 million shillings. So come and talk to Stanbic. If you can't reach anyone, come and talk to me. I will keep to someone. Actually, before I got onto this call, I was linking my RM to someone who attended our investor call this morning and wants some facilities to stand. But come and talk to us. We can facilitate that. 8.99% is market beating, and you get that for 25 years. You can really secure a home for your family. Then we've got in there is asset financing, which we've also done. There's some shorter term trade facilities that we have seen. We have lent. We've increased our SME lending by 14%. That is actually the 25% that you see. It's only muted by the fact that some of the corporates on the other side I described do borrow some chunky numbers.
Now we are going down the income statement. I think now we are somewhere near the EPS, the profitability down there. I think it was pretty good. Once you get the profitability, then after that you need to discuss what to give to shareholders. And shareholders are pretty happy with 22.35 total dividend per share for 2025. And a higher payout ratio, relative earnings definitely, even though the EPS was a bit stable. Give us your thinking around your retained earnings, what's the group policy there in that regard? Should shareholders expect that higher payout ratio to keep going up? What's your take on that, Dennis?
That's a very good question because we have to think about how we reward our providers of capital alongside rewarding employees, rewarding society for allowing us to operate in their environment, rewarding our regulators by being a good citizen, rewarding our suppliers, etc., etc. In the end, we have, in a way, to reward our shareholders. 22.35 is about 64% divi payout of the profitability that we have. So I am still left with 36% of organic capital to continue expanding. What is the group guideline on this, or what principles do we have? Because we actually have policies around this. The first is around ensuring that we have sufficient capital to continue growing. And we do have ambitions to continue growing. We have conserved capital for that. Number 2 is to ensure we meet regulatory capital requirements. We have sufficient capital. You will see, for example, our core capital is at 14%. The regulator has set a minimum of 10.5%. So we are 350 basis points above that. So it's sufficiently provided. The same goes for total capital, where we are about 17.4%, and the regulator has set a threshold of 14.5%. So we've got a bit of buffers to ensure we comply with the regulatory capital. The third link, and which is linked to those buffers, is risk absorbency. We do go through a process called an ICAP, which is internal capital adequacy assessment process, which is to predict some risks that might be coming in the horizon to the extent that they are plausible. And we do have to carry a bit of capital because we're in a risk-taking business anyway, and we need to have some of those buffers. Once we have met those criteria, we have growth in the horizon, we have met regulatory thresholds, and have kept something for risk absorbency, the rest goes to the shareholders. We do have a target of between 50 to 70%, so 64 feels sweet in there. And yes, 7.4% growth in the dividend payout for the shareholder who was with us from 1st of January 2025, a 44% capital gains between 1 Jan 2025 to 31st December 2025, and an extra 25% capital gains between 1 Jan 2026 and today. I think that's a happy shareholder.
We finished the dividend policy. I just want to talk a little bit about balance sheet expansion. So the balance sheet was up by 19%, pretty robust. I think you have now $500 billion Kenya shillings asset-based bank, and that's pretty good. Tell us a bit about the South Sudan engagement and how it's going, the market there. A lot of Kenyans have not perhaps understood how South Sudan is as a state itself. So you can tell us a little bit about the performance of the subsidiary there, and then you can also tell us a bit about SBG Securities, also which people should also be more aware about.
So the South Sudan operating environment is one that sometimes can be unpredictable. And look, I was having this discussion with someone in the bank the other day, and they told me, look, actually the world as we knew it is probably all unpredictable. I think it's a very sad story, but some of us have always considered the UAE, for example, as very safe. And look at what is happening now. The world is a difficult place, all and sundry. But South Sudan, like many other jurisdictions, has its challenges that we have to navigate. When we started 2025, because of the war that's still going on in Sudan, and I know you said some people don't understand how South Sudan operates. But if you think about it, or if I can draw a picture, South Sudan, of course, as a country came to be in 2011. South Sudan is extremely rich in oil reserves. I think there's still 3 billion barrels that are not mined. They do mine about 175,000 barrels a day. The infrastructure as it is set is that they do pump that oil through a pipeline that goes through Port Sudan. Now, that is the country that used to be one, so it goes through another country. Now, that country has been fighting for the better part of 2024 and early 2025 because of the fight in the north. There was a force majeure that those companies could not pump oil. Now, if you think about it, South Sudan as a country, as a nation, receives or gets 95% of its revenue from that oil business. So it was a pretty difficult market. We did still remain resilient in that market during that period. Our teams really worked hard to keep those client relationships going. The other thing that has happened, of course, with Trump is the other big sector in South Sudan is what we call the IDG. The donor organizations, they do have the WFP, etc., etc. It's a big player there with the tariffs that have happened that have come down. So it's a bit of a difficult environment. Now, we've continued to operate. We have grown actually our profitability in South Sudan because oil started pumping towards May of 2025. So the problems I was describing was largely from the second half of 2024. They went away after an agreement in Q1 2025. Oil started flowing. You will then see that translate to a 32% year-on-year increase in our profitability. Still small relative to the 13.7 billion profit that comes from the operations in Kenya. $2 million, 233 million shillings feels more, but it's a business that we are very, very proud of. There is an issue we are navigating now there with the regulator with regard to capital. There's a new capital regulations that were introduced to require additional capital to be injected in that market. We are actively engaging with the regulator to manage that situation because we have interpreted that to be a little disproportionate for the size of operations that we have there. SBG Securities has done a fantastic job. 69 million shillings in profit is really good if you think about 20 million in the previous year. So that's 3x or more than 3x in terms of profitability. So very happy with that business. It was helped a lot by the market activity. We did see NSE market activity or equities activity go up 37%, bonds activity up close to 70%. So that helped that business. It is also the legal entity that actually houses our asset management business from a legal entity perspective because it has a license. So some really good work that has gone on there. Bancassurance, which is the other subsidiary, 8% up year-on-year on profitability, double-digit growth in revenue. Very happy with the work that we've done there. So very happy actually with all the operations, excusing the bank operations in Kenya, because that is where most of the pricing challenges were.
I can't avoid this bit. You have quite a bit of cash and reserves. One listener here is saying you have 350 basis points above core capital. You have headroom above a regulatory minimum. So he's asking, at what point does this buffer become excess capital that should be returned to shareholders? And does the 50 to 70% payout target have room to move towards the upper end? I think that's the first bit. Then the second bit, which I want to anchor on that, is that there are a lot of entities that are in the market in terms of which have not met the core capital requirements, and you're way above that. Is there room perhaps to exercise that to make an acquisition locally? And perhaps you are wondering whether you were in play for NCBA, by the way. If you have any comment on that.
Go ahead, there's a joke that goes, if you want to talk to me directly,
don't go through the corners.
It's really an amazing question. So when does capital become too much? It's too much if you have no plan for it, or if it's too much if it is above the buffers that you've built for plausible risk scenarios. The one thing that is dangerous is to fly too close to the sun, such that if anything were to happen, you would not be able to absorb those risks. The 17% or the 350 basis points that you see, in part, is actually in anticipation for growth that we have. So actually, if I stand still and we exercise the growth, or we generate the growth that we have planned in our business strategy, that capital should be consumed in terms of risk-weighted assets that will come through. So that's how I would answer that question. That capital also is available for investment, yes, to the extent that there will be opportunities to invest. We've said this, organic, inorganic, partnership is our three-pronged approach to grow, to the extent that there are opportunities to go beyond the organic, and that may be in the form of a partnership where we need to invest some cash, or an inorganic acquisition, then we will go for it. And what does that look like? You have to go through the rituals of, what am I buying? What is it that it is going to add to the business that we have, and to execute the strategy that we've chosen? Number two, where do I see the synergies coming from? And what are the potential dis-synergies that I need to manage? And number three, what are the capabilities that this acquisition brings that I want to bolt up that necessarily I do not have and I don't think we can build from an organic perspective? And then number four is, at what price? Because if you acquire at the wrong price, then you end up with value destruction, because you end up with too much balance sheet density that is not tangible and producing some outcomes. Those are the dynamics we would have to go to determine whether we are buying. I'm explaining that because it is not enough that there will be candidates for acquisition or banks that may be available for acquisition or for transactions. We won't just go and buy because we have the capital and someone is available. I think we have to go through those value analyses. And then, were we in play for the famous Nedbank transaction with NCBA? I think, Eric, the way I would answer that question is, we've said this market is rife for corporate transactions. And we've said that East Africa is attractive. East Africa generally is expected to grow by between 5 and 7%. And we said that in 2022. The rest of Africa is expected to grow at about 3 to 5%. So the eyes of capital, wherever they sit, whether they sit in South Africa, in Europe, now in Tanzania, are looking into East Africa, and particularly Kenya, because you don't get into East Africa until you've gone through the heart. So we've seen Asahi happen with Diageo. We've seen, as late as yesterday, NMG get into transaction. We saw Nedbank come in this market. We saw the new CEO of Absa Group come and pronounce, and I think in their results announcement yesterday, they also did make a comment around it. We've seen Vodacom make some move on Safaricom. We've seen KPC and the uptake actually being from foreign investors. That says that our philosophy that there is opportunities to acquire is true. Now, were we in any of those transactions? Now, which one?
That's a good question. But I think I like your thinking around acquisition. You put it, it's not that availability that is the main concern. Sometimes also it has to be a good fit. When there isn't a good opportunity, then you just synergize and then go forward. That's about it. And you just don't want to splash around shareholder cash just for the sake of it. You want that to be high quality shareholder cash that when you splash it out, you have a good ROI at the end of the day. Is that a good way to put it?
Absolutely, absolutely. And by the way, if you go globally, including in some of the industries that are said to be doing very well, telco, media, blah, blah, blah. We've seen these acquisitions become very well pronounced, and then they go horribly wrong because either you overpaid or you never did your value analysis very well, financial analysis, culture, fitness, etc., etc. So it is not to scare anyone out of acquisitions or out of transactions, but just to say it is something that we all have to watch out for. And unfortunately or fortunately, I am charged with that responsibility or value management. So believe you me, it is something I am actually held accountable for thinking through.
And that's right. People should know that your title includes Chief Value and Finance Officer. So I think it's very important. And so you're thinking about shareholder value day and night.
Yes. That's what I am charged. That's the responsibility.
I want to move to the tail end. Someone says the payout ratio is the capital that you pre-allocated to planned growth does not materialize.
I do hope for that question is a shareholder, but that is the main. Look, we have no problem accelerating dividend payment if the growth doesn't come through. Because why are you keeping the capital? In fact, it's destroying your ROE if you think about it. So to the extent that growth doesn't pan out, we will go ahead and pay the dividend. And then we'll ask the shareholders to inject capital if then we have a big transaction that we need to finance. And by the way, in my investor call engagements, this is one thing we put on the table. We want to manage risk. We don't want to manage fear. So we don't want to carry capital at 21, 25, 26% just because we fear that the world might turn upside down, etc., etc. We'll say that we'll pay out the capital, we'll distribute the dividend, but then please allow us to come back to you. Should that happen to be the case, to ask for this capital, should there be an opportunity for us to invest, grow beyond the capital that we have, etc., etc. We haven't had to do that, but it's always a placeholder that we put in our conversations with shareholders.
Now, at the tail end of the conversation, I wanted you to talk a little bit about AI. I think you have some quite robust initiatives in that regard. There's a lot of talk around the globe of people losing jobs to AI. How extensive is your use of AI, and how are you seeing any ROI in that regard?
So first, I agree with commentators across the globe who say the buzz of AI is probably overplayed. I think there's responsible use of AI to the extent that it helps human beings undertake a lot more meaningful work. Now, Eric, I finished school many years ago. I would like to claim at the time when I started my career, I started as an auditor. And when I went to audit, I was given a physical file with reconciliation, bank reconciliations. And I literally had the bank statement on one side, the ledger on the other side, and the reconciliation that showed the outstanding. And it was my job to go and tick against those things and ensure that was actually what we were testing. And then after I did that, I had to go and queue for the computer and tell my manager, okay, can I book the computer tomorrow? Okay, guys, I am not that ancient, but I'm just describing a scenario that makes the conversation a lot more palatable. Technology has advanced since then. It has allowed some of those mundane tasks to be run by bots. We now have bots that help us with the reconciliations within the bank. In fact, because I am previously from the audit profession, whenever I speak to some of the newbies in the audit profession, they tell me even sampling now is being done by AI or by use of AI, some of the things we did at the time. So what does that all mean? We have people, human resources deployed into meaningful work. So what does our team in reconciliation do? Instead of printing those papers and ticking with a red pen and another blue pen on the other side, let our bot do that and then tell you these 5 transactions don't make sense. And then you spend the meaningful time going to understand what are those 5 transactions, why did they happen, why are they not booked on the ledger, or why are they showing on the bank statement and not on the ledger, etc. etc. The same goes for credit scoring. I still remember my experience trying to get my first loan after I finished school, and the only thing they didn't ask for was a blood sample. But now, using my mobile banking transactability, my account statements, you can ingest that into a tool and you can say, you know what, Dennis looks like you can afford 500,000 shillings or 100,000 shillings or whatever the limit is. That's how we see AI or some level of digitization in how we make decisions panning. The example I gave very early on around fraud risk management, we can ask AI to say, monitor how Dennis kind of runs his account, and it can create a thinking that says, actually, Dennis tends to have a lot of transactability towards the end of the month, so it looks like a salaried employee. And then we see a lot of bill payments, he's paying electricity, he's paying workers, whatever it is, etc., etc. And then it goes dormant. So if we see a lot of activity on the 14th of the month, or if we see a lot of activity on Dennis's account at 2 a.m. at a time when we don't expect him to, we can help Dennis protect his value. Where do I think this will go? If we're able to get to a point where, and regulations would have to allow for that, but we can say, we see Dennis in Githurai most evenings. So that looks like he's home. And I know where I'm going is a bit dangerous, but that looks like he's home. And therefore, we will use that to determine his residence. That's some of the progressive work we would want to explore, subject to regulation allowing, to move the needle. But AI is to aid humans engage themselves in more meaningful work and not necessarily to replace them.
2 quick questions maybe as we finish now. So one, what are you looking at, especially in 2026? What's top of mind for you? What are some of the themes? I know the war in the Middle East has appended most of the conversations that people are having for this year. So perhaps for you, how are you looking out? What are the sectors that you're focusing on? And then perhaps after that, you can share with us what you're reading and maybe your takeaway, at least from 2025, and something that you want to maybe work on in 2026 yourself. Just those 2 questions and then we close.
What are we watching? I think there's 3 or 4 things we're remaining alive to. So the first is what you've alluded to. The war in the Middle East, depending on how long it stays, is likely to have first order, second order, third order effects. I don't think we say enough as humans about the human devastation, the destruction of peace and livelihoods, deaths that are happening. And I think that is a first order effect, which is really sad to see. I did see commentary that on the first day, kids were bombed in school. I think that's just horrible. Then linked to that is then what happens to supply chains, that strait that everyone is now talking about. What happens to shipments, etc., etc. Closer home, I did hear the ministry talk about we have sufficient supplies. How many is sufficient and how long can we stay? And what happens to some of those arrangements? So those are some of the things that we need to think about. There is a third kind of strand to this, which is likely to drive. It's already driven oil prices up. What is it likely to do to inflation? When inflation ticks up, what happens to interest rates? When interest rates go up, what happens to credit demand? So there's those effects that are likely to follow that we are watching. Locally and regionally, we are thinking about the primary one is actually helping customers transition to the new pricing models and just watching to ensure that none of them is put out of kilter and their businesses continue to run. The second thing is we have been through cycles of elections. We do know how customers tend to behave. Some of them like to stock up, especially for those that are into the supplies world. So we might see a bit of that demand tick up and then start to taper off as we come closer. We have seen some investment hesitation that happens. This is something that is documented by economists. So again, we are then talking to customers to just see what that exactly means as we get into quote-unquote electioneering or early electioneering. And then, of course, there is natural things that we are dealing with that are coming at us. What happened on Friday, climate risks, things that today we are talking about who is likely to default because their salaries went this way, to someone's car being swept the road. And now you're dealing with all different issues. Those are some of the risks, but that risk world also presents opportunities for us to think about customer protection in the form of facilitating insurance. It presents opportunities in terms of OD lines or overdraft lines for some of the customers who do not want to commit to long-term financing. So that's how we balance that equation so that we can generate a return. What am I reading? I'm reading a book called Distancing. It was actually a Christmas gift. My team will not forgive me for this. But my team bought me a Christmas gift last year on a book called Distancing, just basically taking a sit back and reflecting on how things are going and taking a strategic view, riding above the wave and seeing whether you're too close to the action and therefore missing the bigger picture. I don't know what the team was communicating. I'm still going to ask them after I'm done reading the book.
Thanks, Dennis. Anything else we may have missed? Or maybe you can close for us?
No, really happy to have had this conversation. So I do hope that has created some illumination to the business that Stanbic runs. I am very happy that we are now the 6th largest bank in the market. We were 9th in 2021. We were 8th in 2022. We were 7th in 2023. We were 6th in 2024. This is not my analysis. This is a report that is published by the central bank at the end of every year. It comes out in the middle of the following year. So I look forward to our indexing in 2025. And if I've not done enough job to convince you to invest and bank with Stanbic, I think I'm going to take a pay cut. Thank you very much.
Dennis, you're a pleasure to host always. So it's fun. You make the numbers make sense to people. You provide value. So the value in the CVA4 is very on point. So thank you so much, Dennis.